Dallas-Fort Worth posted quarterly net move-outs for the first time since second quarter 2009. Now, the declines were small, but what does that mean, if anything? And apartment construction is kicking back up. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Dallas-Fort Worth update. For the first time in 9 quarters, DFW posted negative quarterly apartment absorption. Take a look at this chart here. You can see the decline was small, just 269 net move-outs in first quarter, not more than a blip, and certainly nothing to worry about in the big picture since the local economy is humming along and because Q1 is typically a seasonally slow leasing period. But as we alluded to in a video earlier this quarter about the single-family home market coming back, Texas has always been expected to lead the recovery in the single-family home market, and that appears to be the case. In first quarter 2012, we saw a little bit of net move-out activity from suburban areas in both in Dallas-Fort Worth and also in other Texas areas, and that has correlated to the beginnings of a rebound in single-family home sales. Now, again, going forward, we don't think that's going to be a significant factor just because total job growth should be strong enough to feed both single-family and multifamily. Now let's take a quick look at occupancy and rent numbers. Occupancy is at 93.1%, down 0.2 points for the quarter, but up 1.5 points annually. And rents jumped 0.6% in Q1 and 4.5% year over year. All very good numbers. Meanwhile, new supply levels in Dallas-Fort Worth remain very low by DFW standards. North Texas historical average is about 14,000 units completing annually, but just 5,516 units completed in the year ending first quarter 2012. Now, of course, as we mentioned earlier, that is starting to change. DFW has 12,437 units under construction, and about 2/3 of those are slated to complete in the next 4 quarters. Still, those numbers don't rise to the level of concern. First, because DFW's job growth has been so strong and should continue to be, but also because in that last cycle we saw a big wave of construction and those properties leased up quickly and during a period of recession. And we're going to take a look at that a little more closely and show why we don't think supply is going to be a major problem. Let's look back at that past cycle, 2008, the start of 2008, to where we are now. That includes the recession. And we're going to focus on the Dallas side of the Metroplex and look at some numbers here. Dallas built 37,268 units since the start of 08, and on net has seen basically no job growth since that time in those 4+ years. Now I'm going to split Dallas, we're going to pick Dallas in particular, into 25 submarkets. Group A is the urban core, so downtown, uptown, Oak Lawn area, plus all the northern suburbs, Collin County, Denton County, and some of those suburbs right around there. And Group B is everything else. Now, Group A, as you can see here, got more than 31,000 new units, expanding the inventory base there 14.9% during a period of basically no job growth. And yet, occupancy is at 95%, full and back to pre-recession norms, and since 4Q07, same-store rents are up 4.4%, more than double the national average. And Group B, as you can see now, is a different story. Not much supply, but occupancy remains weak at 92%, and it's down 1.8 points since fourth quarter 2007, and rents are up 2.4% in that time, even though rents here are 40% cheaper. That's nearly $300 a month compared to less compared to Group A. So how did that happen? Well, first of all, there's a lot of reasons for that, a lot more than we have time to get into in a short video. But one big reason is that the recession disproportionately hurt working class, blue collar jobs that are more closely associated with those Group B, more affordable submarkets. And in the recovery, we've seen a faster growth in those Group A submarkets that tend to be more concentrated with white collar, service oriented jobs. And going forward, that's where the construction continues to go, to those Group A submarkets. And given that they absorbed all that new supply so well during a period of a downturn, there shouldn't be too big of an issue, at least long-term, leasing up the new product that's on the way, especially since we're not yet anywhere near those peaks levels that we saw in construction prior to the recession. So going forward, overall, look for total housing demand to be strong enough to feed both single-family and apartments due to strong job growth. And overall, we expect that the next 12 months will be just about as strong as these past 12 months for total apartment revenue growth. And that wraps up for DFW. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.